What is cap rate? Cap rate is one of the most commonly used metrics in real estate investing to evaluate the return on investment, ROI, of an income-producing property. It represents the rate of return based on the expected income the property will generate. Cap rate is expressed as a percentage and helps investors compare the profitability of different real estate investments. Cap rate formula. The basic formula for calculating cap rate is text cap rate equals FRAC net operating income, NOI, property value, or purchase price. Net operating income. This is the annual income the property generates after operating expenses, but before mortgage payments, taxes, and depreciation. It's calculated as equals gross operating income, operating expenses. Property value or purchase price. The current market value or the price at which the property was purchased. Example of cap rate calculation. Let's say you have an apartment building with the following numbers. NOI, $150,000 annually. Property value, $2,000. Using the cap rate formula, text cap rate equals FRAC 152,000 equals 0.075 equals 7.55%. This means the property has a 7.5% cap rate. What does the cap rate indicate? Higher cap rate. Generally, a higher cap rate indicates a higher return on investment, but may also reflect higher risk. For example, properties in less desirable locations often have higher cap rates because they may involve more risk, such as higher vacancy rates or lower quality tenants. Lower cap rate. A lower cap rate suggests a lower return on investment, but may imply lower risk. Properties in prime locations or with stable income streams may have lower cap rates because they are seen as safer investments. Cap rate calculations. There are three primary scenarios where you might use the cap rate formula. 1. To evaluate a property's raised rate of return. If you know the property's NOI and its current market value or purchase price, you can calculate the cap rate to determine if the investment meets your desired return. Cap rate equals FRAC, text, property value. 2. To estimate a property's value. If you know the cap rate in the area and the property's NOI, you can reverse the cap rate formula to determine the approximate market value of the property. Text property value equals FRAC, cap rate. Example, if the NOI is $150,000 and the typical cap rate for similar properties is 8%, you can estimate the property's value as text property value, FRAC 150,000, 0.08 equals 1,875,000. 3. To compare similar properties. Cap rate allows investors to compare properties with different values and NOIs. For example, two properties with different prices can be compared to see which provides a better return on investment. Cap rate example. Comparing two properties. Property A. NOI, $200,000. Property value, $2,500,000. Cap rate, FRAC 200,000, 2,500.08 equals 8%. Mine's property B. NOI, $300,000. Property value, $4,500. Cap rate, FRAC 300,000, 4,500,000 equals 0.067 equals 6.7%. In this case, property A has a higher cap rate, 8%, compared to property B, 6.7%, which suggests that property A may provide a better return based on the purchase price, though it could also involve higher risk. Factors that affect cap rate. 1. Location. Properties in high-demand, low-risk areas, such as urban centers or desirable neighborhoods, often have lower cap rates because they are considered safer investments. Properties in rural or economically depressed areas tend to have higher cap rates to account for higher risks, like difficulty finding tenants or fluctuating property values. 2. Property type. Different types of real estate, residential, commercial, industrial, will have different average cap rates. For example, commercial properties like office buildings might have higher cap rates than residential properties because they can be riskier. 3. Condition of the property. A newly renovated or well-maintained property will typically have a lower cap rate because it may have fewer maintenance issues and a higher chance of steady rental income. Older or distressed properties may have higher cap rates because they require more maintenance and may have less reliable income streams. 4. Market conditions. Cap rates tend to fluctuate with market conditions. In a booming real estate market, property prices often rise faster than rents, which can compress cap rates. In a recession, cap rates might increase because property prices fall, making the ratio of NOI to property value higher. Limitations of cap rate. 1. Doesn't consider financing. Cap rate does not take into account the effects of leverage financing. It only evaluates the property as if it were purchased entirely with cash. To get a full picture of an investment's profitability when using debt, you would need to look at metrics like the cash-on-cash return or internal rate of return, IRR. Number 2. Assumes stable NOI. Cap rate assumes that the NOI is stable over time, which may not be the case. Changes in rent, occupancy, and expenses over time can affect the property's actual profitability. 3. Does not account for appreciation. Cap rate focuses solely on income and does not account for potential appreciation, increase in property value over time. Some investors prioritize appreciation over current cash flow. Number 4. Ignores tax implications. Cap rate does not consider the tax benefits or obligations associated with the property. Things like depreciation, tax write-offs, and capital gains taxes can impact the overall return on investment. Cap rate and risk. The relationship between cap rate and risk is important. Generally, higher cap rates equals higher risk. Properties with higher cap rates might offer more income, but they are usually in locations or situations that are riskier, higher vacancy rates, lower quality tenants, or older properties. Lower cap rates equals lower risk. Properties with lower cap rates might have steadier income streams and be located in desirable, low-risk areas. Conclusion. The cap rate is a crucial metric for assessing the return on a real estate investment based on its income-generating potential. It's used by investors to evaluate the profitability of a property, estimate its value, and compare it to other properties. However, it should be used in conjunction with other metrics such as cash flow, appreciation potential, and debt costs to get a comprehensive picture of an investment's viability.